we are now live. So, hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your money show host for this session. I do have Owen here with me in the Zoom room. We will begin on time at 11:50 a.m. That is Eastern time, coming up again in just a few short minutes. Thank you all so much for your patience. I hope you're having a wonderful day and enjoying the show so far. To those of you just tuning in, hello and welcome. We do still have a couple of minutes to go. The next session will begin on time at 11:50 a.m. That's Eastern time, again in just a couple of minutes. Thank you for your patience. Hello, everyone, and welcome to the session. I'm pleased to introduce Owen Tracy. He's the CEO and head analyst at Fuller Tracy Money. Now, that's a global investment strategy service. He's also the author of Crowd Money, a practical guide to macro behavioral technical analysis, and he manages the Global Corporate Autonomies Fund in the UK. Now, to our live viewers, please share any questions you may have throughout this session in the live chat box. It is on the right side next to your video player. With that all said, Owen, I'll hand the mic over to you. I will be here if you need me, but the floor is all yours.
Well, wonderful, and it's just an absolute pleasure to be here for the virtual conference. It's much more comfortable being right here in my office, and I think we've got a big question in front of us. And you know, everyone is talking about dismal consumer sentiment, and then worried about what AI is going to do to the global economy. Are we all going to be homeless, jobless? Are we going to starve to death? Or are we going to live in a panacea where everything is taken care of for us? And I think, we need a little bit of just grounding. So I've got a couple of charts to share with you, and I think that it'll put some context on. Now, this is an enormous bull market. And we have seen, I actually sent this suggestion for the title of the presentation about 6 weeks ago. And in that 6 weeks, we've seen just an enormous jump in the performance of some of the AI stocks. even yesterday, Jensen Huang basically said that Marvell Technologies should be a $1 trillion company. It went up 30% in a day, simply on the back of that one statement. And it's still only got a market cap of 248 billion. So it could go 4x, and it would still not just about reach the anticipated value that Jensen Huang put on the share. Well, what that tells you is that we are running on a very hot market. Now, let's just move ahead a little here. There's a lot of concern right now. I'm going to just minimize this so that everybody can see the top right of the chart. Well, this is an excellent chart from Thorsten Schlock at Apollo. And for anyone who doesn't know, he puts out a daily chart, and some of them are really insightful. I'd recommend signing up for it. And it's free. But you can see here that business applications are actually trending higher. So lots of people feel that with the assistance of AI, it's easier to start a business. Maybe you don't have to have the additional cost of that first employee. Maybe you can just start your business and see how it goes for a while before you have to make the decision to hire somebody. At the very least, what it's doing is allowing people to game it out so that you can test your hypothesis and you can figure out, well, what might work, what might not work before you pull the trigger. And once you do pull the trigger, well, then maybe you actually have a better standing. So then that dismal figure of the number of new businesses that fail in their first year might actually get better. Now that's something that could be really encouraging. Now let's move on here. There's a lot of people talking about unemployment and that there are going to be so many job losses, and the number of people I've talked to, and particularly people that are actually working in the technology sector, talking about the number of people losing their jobs. I think this is something that's really very important. This is a long-term chart of unemployment. You can see that there have been some significant peaks. It's not all that unusual over the broad span of history to see unemployment at 10%, and that is generally the bottom of a major cycle. Well, we're nowhere near that. And in fact, but if you look at just the right side of the chart and all the way down there, in fact, unemployment is going down. So there is not a problem here, but it is one of the things that people are most afraid of, that they're going to lose their job as a result of AI. Whereas I think for the broad swell of the population, they're probably just going to find themselves more productive as a result of AI. But here's where things get really interesting. This is the University of Michigan Sentiment Index. Now, that reading is terrible. And I think it needs some explaining. We should be thinking, is this a terrible reading or is it a terrible indicator? And there's a lot of data behind what exactly goes into this sentiment indicator. And who do they actually ask the questions of? So it seems to be very politically skewed. And then it's also demographically skewed. What we can definitely see, though, is that there was a very significant peak in 2020. And I think it is reasonable to anticipate that consumer sentiment went down during the pandemic. And then it never recovered by this reading. And then it really started to go down in 2025 and 2026. Well, the economy is doing fine. In fact, growth is well ahead of expectations, and unemployment is improving. So how could sentiment be this bad? Well, it would be this bad if you were perhaps more elderly and you had a really jarring experience during the pandemic, and you were thinking that maybe your life was in danger. And then because you've gone through that experience, well, perhaps you just think that nothing is ever going to get better. And every time there's a problem, then it is going to represent the same kind of danger to your person. And of course, if that is how you're thinking, and for example, people still walking around with masks in 2026 because they're terrified of being infected, well, obviously, this affects some of those people's sentiment. And if those are the only people answering this particular survey, well, then it's going to give us a really significant deteriorating sentiment. But I think this is a much better way of thinking about sentiment. This is an index produced by FINRA. It's margin balances in securities accounts. And since we're talking about the markets, it's probably better not to look at consumer sentiment. We need to look at investor sentiment. Well, we're at a new all-time high. So what this tells you is that people are long and levered. And when this index becomes very overextended, it's generally coincident with the significant peak. Now, it did pull back, and I think it's something very important to emphasize about this index is that it's updated monthly, but it's updated with a 3-month lag. So the last time it was updated was right at the end of March. And of course, we know what happened at the end of March and all the way through was really the beginning of the war with Iran. So that certainly hit some of the risk-taking behavior. I'm going to be very interested to see how it is performing now. Of course, we're not going to know how it's performing now for another 3 months. So this is not a coincident indicator, but it will certainly be a confirmatory indicator, because when it does begin to trend lower, well, then that is going to represent a significant peak in the stock market. It wouldn't be just a mild pause. It wouldn't be a reversionary process. If this thing starts to pull back in a big way, then we should be prepared for a repeat of something like 2022 or a repeat of what happened in 2018. Now, I think that 2018 period is very important because that was the last time we had a new Fed chair. And Kevin Warsh is going to give his first press conference in 2 weeks' time. And now the next question is, what will the Fed do about interest rates? Now, that is something that we really don't know. But what we do know is that the 2-year yield is currently trading above 4%, and the Fed funds rate is at 3.75%. So the bond market is implying that the most likely direction of interest rates will be a 25 basis point hike. Now, will the Federal Reserve be willing to do that? And would that then contribute to less risk-taking behavior in the stock market? That's not a question for today. It's probably more of a question for out there in the middle of July. But this, I think, is a much better indicator of sentiment in the stock market, which remains exceptionally bullish. Now, this is a really, I think, very illustrative package of charts. So we can see that the labor market has been weakening. It's probably more about interest rates than AI. And then when we talk about the employment in the information sector, well, you can see that the gray line right in the middle, that's information technology, software, web search, streaming, and hosting. Well, yes, it has been falling, but it went up an awful lot during the pandemic. Where you're certainly seeing more job cuts is in more what we might consider to be soft skilled. So movies, newspapers, telecommunications, TV, radio broadcasting. That's the kind of thing that is under threat, but probably not to nearly the same extent, or to the extent that people are fearful of. And then a lot of people are talking about that there's not nearly as many people being hired as I guess, entry-level employees. But youth unemployment is falling and has been falling aggressively. So what that tells us is that that was probably reasonably short-lived. So there isn't really a lot of need to be hyper vigilant about the economy. But then, of course, what's the other thing people are worried about? It's oil. And I can't tell you how many times I've heard people saying that we have record high oil prices. Well, that might be true of gasoline prices, and that would be heavily skewed by whichever state you live in. But the oil price itself is nowhere near an all-time high. And at about $96, that's the lower side of a short-term range. And there's been sufficient damage done to global supply that I think a drop back below $80 will be rather difficult, at least for the next 12 months. So we're probably in a higher for longer oil price environment, but that does not mean that it has to go above $120. And there are a lot of people really fearful that there's going to be a massive surge in energy prices. But I really still think that that is unlikely, that there's still plenty of supply outside of the Middle East, and we've had quite a lot of demand destruction. China, for example, has reduced its demand by 5 million barrels a day, and they can sustain that for a good long time because of the size of their reserves. And they're also the largest producer of batteries and solar panels. So if we were really in an energy crisis, they would massively increase the production of those. But there is an additional way of looking at this, and it is that if we were to look at oil on and I guess adjusted for the purchasing power parity of the dollar, well, now we can see that it really was an energy crisis in the middle of the 2000s, and oil prices went up in an incredibly accelerated manner. And since then, they've been generally trending downwards. And the price right now is really not all that different from where it was back in the early 1980s. Now, arguably, that was also a high price, but it's not nearly as high a price as a sort of a factor for the economy as it would have been back in the 2007 through 2010 period. Now, we've had just an incredible move in the semiconductors index. It's not far off doubling in about 10 weeks. So this is a really impressive acceleration of the overall trend. So I think this is something we should be paying particular attention to, because accelerations like this, they don't last forever. So I think we should be looking then at, I think, a very useful comparison. Now, I know that there are a lot of lines on this chart, so I'm going to talk you through what it's looking at. But this is a long-term price and valuation chart for Cisco Systems. And at the peak in 2000, it was the largest company in the world with a market cap of 550 billion. And it's accelerating right now, and it is back at that 550 billion market cap. So there's a little bit of back to the future element to all of this. But I think that it's very important to just look at this, what was happening in the 1990s. So you have the white chart is the market cap, and the market cap just went bananas right all the way through the late 1990s. On the back of earnings per share, which is the blue line, which went up about 4 times. It went from 3 cents to 12 cents per share. There was the expectation that that would persist indefinitely, but it did not happen. There was a massive drawdown in earnings per share, but what was completely ignored by the market after the crash was that that earnings per share actually recovered, and it did manifest. That earnings per share growth continued, but the expectations were that it would not just go up in a sort of at a steady level, but that it would have had accelerated. And that is what was happening with the PE ratio, which is the purple line. And then we have the orange line. In order to fund the massive amount of investment in new infrastructure, back in the 1990s, Cisco was issuing a lot of shares, and they took that share count up to about 7 billion. So that was a massive bull market, more supply, higher valuations, earnings growth that was anticipated to then accelerate as well. Then that didn't happen. Well, that was really what contributed to the crash. Well, then we had what was after that was what's called a secular bear market, where you have a generational long period of rising dividend yields, and the company instituted a dividend in 2011, and it has been raising that dividend by about 2.5% a year, and falling PE ratios. And of course, that PE ratio went sideways for a long time, right there. So massive PE ratio contraction amid a period where the number of shares outstanding halved. So then we had, when the PE starts to rise again, we have limited supply, we have earnings that have been growing for a decade or more, and now the market cap is accelerating. I think these are important things to pay attention to because we have that long history with Cisco. And now let's compare that to what's happening in other markets. Now, this is what happened with Cisco. It did fantastically well, then it crashed, and it did nothing for the next 15 years. And it only was really able to break above the $20 level in 2016. And then it got back to the all-time high, and now it broke out, and now it's running. And it's a massive acceleration, but there's no sign that it's over. Now, let's just think about one of the companies that is very exciting right now. This is Lumentum. Now, it's been around for a long time. And when it first hit the market, the number of shares went up, and then they started buying back their shares. And that started in 2019, and it pretty much ended in 2023. And now we have revenue, earnings per share anticipated to break out. The market cap jumping higher, the number of shares jumping higher. This is emblematic of what happened with Cisco, but it happened with Cisco in probably 1996. And then we had this phenomenal advance, not just going up some, but going up in an incredible period. And that was emblematic of a mania. Now, what is characteristic of a mania is that you do get earnings growth. And people start to think, well, then that's going to get way better than that. So you're starting to see that growth projections get even more aggressive. And ultimately, then what you start to see is people forget about valuation. They forget about the role of interest rates. And ultimately, it's when I would say one of the things to pay particular attention to would be if we continue to see these very strong moves on the upside, when the Federal Reserve starts raising interest rates, then that would tell us that not only are we in a mania, which seems to be quite obvious, but that we're also at the end of that mania. Right now, there's no evidence to suggest that the mania is anywhere close to ending because the volume of cash being spent on AI data centers continues to accelerate. And now that's Lumentum. It broke out in the middle of 2025, and since then it's up 10x. And this week was exceptionally powerful on the upside. Now, here's another example. So we have Rocket Labs. Now, you can see here there's one big difference. There's only 3 lines instead of 4. They don't have a PE ratio because they don't have positive earnings. But they do have a market cap that has gone up in a profound manner, and the number of shares in issuance is starting to rise. And the projections for revenue have not been particularly impressive. So that is why the share is not going up right now, because it floated up on enthusiasm around the SpaceX IPO, and it really needs absolutely everything to go in its favor in order to justify the valuation such as it is right now. And then let's think about ARM Holdings. Now, I would say that ARM is very similar to where Cisco was in 1996. It's just a pure play on the success of NVIDIA's new chips being put into desktops, laptops, that you're going to have an AI agent in your home. And that is all based upon the lease NVIDIA has agreed with ARM technology. So in just the same way that ARM was a play on Apple before it was taken private, it's now a play on NVIDIA coming to dominate the personal computer sector. And we now see that the market cap is rising, the supply of shares is rising, revenue is expected to break on the upside, and finally, the PE is starting to recover as well. And that PE is at 467. If that PE drops to, say, 350 in the next year and drops to 250 the year after that, well, then investors will be exceptionally bullish about the share because it would suggest that that revenue, that earnings per share is increasing even faster than the price is rising. And that is where you get incredible excitement. So ARM has just broken out. It hit a new high about 8 weeks ago, then surged over the last 3 weeks. And all of that was because of excitement around NVIDIA. So we're in the third psychological perception stage of a major bull market, which is characterized by the mania. Now, everybody talks about the crash, but actually the crash is it's the fourth stage. It's really where you get disbelief about the potential for a bear market. The mania phase is still a bull market. And manias can go on for longer than anyone anticipates. They are when you make money fastest. It's when the investment game is actually easiest because all you have to do is buy. And as long as you're in the epicenter of the bull trend, you will make money. This is also the time to be most vigilant, to be most diligent with your money control discipline. In other words, control the size of your positions, pay particular attention to the average cost of your purchase, but hold on for the continued bull trend, and you will make more money. And of course, then you have the NASDAQ. Now, when the NASDAQ doubles in value in the space of about 6 months, that is usually right at the end of a major bull trend. Now, arguably, it has doubled in the last 12 months, and there have been quite a few dips along the way. But as long as it is still trending higher and the size of the reactions is relatively similar to what we've seen in the past, and most particularly if it finds support in the region of the 50-day moving average, well, then this is still a significant bull trend. But we are certainly in the third psychological perception stage of this bull market. Now, I do want to just give some time for questions. But in the meantime, I would also like to plug a book by my friend. He's one of my subscribers. He actually will be IPOing his own AI health company in the next 12 months. It's called Helix. He's just written the most fantastic book about the scientific method and the burden for proof and the discipline required. He was one of the inventors of Viagra, so he has firsthand experience about how to actually pursue the burden of truth within science. And he's writing this book right now to highlight where the failings are in the current system, because with the pressure that's coming from AI and how AI is trained on a lot of scientific studies that do not pass muster if they were actually critically examined, that we're at an exceptionally important time to get things right. And this is a very accessible book. It's just listed on Amazon today. And it would certainly, I think, be interesting to pay attention to. It's only $9.99, so he's really pitching it at everybody who has an interest in doing science well. And if you want to find me, I'm on Substack, Fuller Tracy Money, or you just Google my name, Owen Tracy, you'll find me. But I'm happy to take any questions right now.
Fantastic. Thank you so much for a great presentation and for leaving a couple of minutes here at the end. Now, I don't have any questions from our live chat just now. I did give them a little reminder to post those in there because they are on a bit of a delay from you and I here on the Zoom call. So while we just give them a minute here, Owen, any other final notes that you think our audience might like to hear, or perhaps a frequently asked question that you've been receiving lately that you might want to share with us?
Well, I think something that I get asked a lot is what's going to happen next with gold. A lot of my subscribers, I was very long of gold and played it, I think, rather well. And now we're in this consolidation phase. I think that a lot of what's happened in gold is because Middle Eastern central banks have been selling it to to provide funding to their governments. As soon as the strife in the Middle East has run its course, I think they'll get straight back to buying. But I would be certainly interested in buying the dip. If we get a more significant dip in gold, I'll be backing up the trailer to buy some of that. And I really think that precious metals are about the best hedge you have against the incredible advance we're seeing in AI. So I think it's more like a barbell strategy. If you're long one, you also need to be long the other.
Thank you, Owen. David in the chat was asking if you can go back to the book name and author, please.
Sure. That's Dr. David Brown, The Scientific Method for the 21st Century. And I mean, I read it. He gave me the preprint version. I was in London last week for, I teach a 2-day seminar on behavioral analysis and how it applies to price action. And he gave a presentation about AI and how to use, and mostly about the cyclicality in various price. And he's not really a technical analyst. He's only coming to financial markets out of his own personal interest. And he's using a lot of the lessons he learned in the scientific method in his own investing. So his presentations twin very well with mine. But I thought that one of the insights he had about the clinical trials was really profound. That about 40 to 60% of people that are reviewing them for journals actually don't look at the data. And it's really about, they're almost like vibe approving. If they like the conclusion, they just approve it without actually looking at the data. And I also am very reminded of Charlie Munger. And he was saying, and he was sort of famous for saying that if you show me the incentive, I'll show you the result. Well, the problem for a lot of the reviewers of clinical trials is they're not paid. They're expected to do it for the love of science. Well, if they're not incentivized to do their very best work, how can you expect them to do their very best work? And that is a glaring omission, I think, in the way that clinical trials are performed and adjudicated on.
Well, Owen, thank you so much. That was fantastic. I do have a comment from one of our frequent viewers here, Initials GB. He says the presentation was so clear, I actually can't think of a good question to ask. So I think that really speaks for itself.
That's quite a compliment. I really appreciate it.
Absolutely. It was very informative. It's a pleasure having you on the show, as always. Thank you once again. And to those of you watching us live, be sure to stay tuned as we do have more in store for you today in this Money Show Virtual Expo. I hope everyone has a terrific day.
Great. And I'll see you at the round table later on today.
That is right. Yes, Owen will be joining us for the stock picking panel later this afternoon. So again, be sure to stay tuned. All right, everyone, take care. Have a great day.